Okay, so a lot of students enrolling classes related to finance would love to learn algorithm trading. Why is that? Why do we love to learn algorithm trading? Because we think that might work, right? But that depends on the efficiency of the market. So what if the market is efficient? Then that indicates algorithm trading won't work, right? So there are currently market efficiency debates on the market or in research. The first stream says that market is inefficient, meaning that all those trading strategies, you cannot beat the market. And there's another stream says that the market is reasonably efficient because there are some investment companies do make profit from building those models, right? And then there's another stream which is related to limits to arbitrage, meaning that the profits are constrained from the frictions in the market, like transaction fees. So it's really hard to make profits by frequent trading. So in this paper, we investigate how sensitive return predictability estimates are to how returns are estimated. Or in other words, how different ways of constructing returns can bring different levels of return predictability. So our method follows a highly cited, recently published paper on the Journal of Finance. The authors are Chinco, Clark, Joseph, and Yihe in 2019. And in their paper, they investigate 1-minute return predictability using US stocks. They apply the machine learning called Lasso, which I'm going to talk more in the next slide. It is a machine learning technique. And what they found is that they document a return predictability with the average out-of-sample adjusted R-square of 2.5%. You may think 2.5% isn't high enough as a prediction power, but think about, we are talking about the 1-minute level return prediction. So that's a high frequency level. So at that high frequency, the price, you can consider the price as random and full of chaos. So in asset pricing at high frequency level, any predictability above 1% is considered meaningful and strong. And they also document an out-of-sample adjusted R-square of over 6% using a simple autoregressive model. But this is surprising given that in-sample adjusted R-squares of autoregressive models are often below 1% in existing work. So here's our model. So what we use is we use a 30-minute rolling estimation window. So for example, for our first estimate of the day at 10:04, we use data from 9:34 to 10:03. So first observation is at 9:34. And then, so for each 1-minute prediction, we use a 30-minute estimation window and 3 lags for each observations. So for the first estimation at 9:34, the 3 lags would be the past 3-minute returns, which is from 9:31 to 9:33. So in these 30-minute rolling windows, we estimate the next minute returns for each rolling window. So the first prediction is at 10:04. And we use observations from 9:34 to 10:03 for the first observation. And we drop the last prediction of the day at 4 p.m. And each stock day has 356 return forecasts. And we use the following regression in Lasso implementation in each 30-minute rolling window on a stock day basis. So here on the left-hand side, the RNT plus 1 minus L is the dependent variable, and that's the realized return. And on the right-hand side, the variables for the betas the X M prime T minus L. These are all the lagged returns on the market. And we use the total number of NYSE listed stocks, which is 2,000 of those. So the capital N is around 2,000. And because we use, for every observation, we use the past 3 minutes returns, so there are in total 6,000 independent variables in these kind of regressions. So this means in each rolling window containing 30 minutes of data, it's solving a regression problem with 6,000 independent variables, but using only 30 observations. So we're not going to solve this kind of regressions unless we use the machine learning. So what this machine learning called lasso do is that it does the subset selection, and we are solving this optimization problem by adding a penalty to a regression model, and this model shrinks some of the coefficients to 0. So we only focus on those important factors that actually can help explain every stock's next minute return. So for example, what if we want to predict the next minute return for Apple or IBM from the past 3 minutes of data? So we know there are 2,000 stocks out there on the market, but as a human, it's impossible to select those important stocks, right? So this is a great method to do the subset selection. So we run this daily regression for each stock for which we predict the returns. On the left-hand side, the RNDT is the realized 1 minute returns on day D at time T, and on the right-hand side, that's the predicted returns by the machine learning called lasso. So by running this daily regression, and we record the adjusted R-squares for all these kind of daily regressions, and these adjusted R-squares measures how well the machine learning does for the return prediction. And the higher the adjusted R-square, the better the lasso forecasts explain the variation of the realized returns. So now I want to talk about the data, in case you are interested in the research related to investing. So we use the New York Stock Exchange trade and quote database. That's a high frequency level data, the highest frequency level you can get on the market. And our sample consists of all NYSE listed stocks with a monthly closing price above $5. Why do we only focus on those stocks with price above $5? Because we want to remove those small cap stocks or those illiquid stocks that may distract our models. So our main sample covers a relatively long period from 2005 to 2012 using the monthly TAC data. So it's not at the monthly level, but it's updated by month, and it's at a second level. And we also use a recent sample to apply our lasso model just to compare how recently the results still hold up. So we use the May and August 2020 data, and that data is updated daily since 2014, and the data is milliseconds. And we calculated 1 minute return by a fraction of the past current price and divided by the prices 1 minute ago and then -1. So that's the ratio of the price at the end of the interval over the end of the previous interval -1. So we construct prices in 4 different ways. The first way is not conventional, which is we directly take the quote data and we calculate the average of the bid and ask prices, meaning that we calculate the average of the prices submitted by the orders from the buyers and submitted the order by the sellers and denoted by TAQ. And then the following 3 ways of constructing the prices are more conventional. So for example, we only use the prices from the New York Stock Exchange and denote it as TAC NYSE, and we use national best bid and offer prices denoted as TAC and NBBO. And we also use the trade prices, and these are actually prices from the actual executed orders, so denoted as TOC trade. And our TOC returns are computed from over 30 terabytes of data, and we compute it using the HPC at SUNY Buffalo. So here's the summary statistics of the 1-minute returns in our models. So as you can see in panel A, the realized returns is about 2 billion observations. And the median return is 0 in all cases. But if you look at panel A, the first data set, it does have a higher mean and standard deviation in TOC. And also we look into the correlations and autocorrelations between these data sets. And we find that there's much lower Pearson correlation with TOC returns, shaded in blue in panel A. And there are much higher correlations between TOC NYSE returns and TOC NBBO returns, shaded in red in panel A. And there's also strong negative autocorrelation found in TOC returns. So that's shown in panel B. So here's the main results using data from 2005 to 2012, based on 2 billion observations. So as you can see, panel A, using the original TOC data, shows a reasonably high return predictability, around 2.9%. But all the other 3 conventional ways of constructing returns all has a return predictability below 0.3%. And this result in panel A is consistent with that highly cited paper by Chinco et al. In 2019. So we want to know why that particular way of constructing returns, as shown in panel A, has a strong return predictability, but why not the other ways of constructing returns? And we motivated by McLean and Pontiff's paper in 2016. So based on their findings, after the publication of Chinco's paper in 2019, return predictability might be lower because if there's a strong predictability based on the results using the historical data, then traders would already take advantage of this high predictability and traded away those profits. So to investigate if previous results still hold up to using a recent sample, we extend the analysis to August 2020. This also allows us to construct midpoint prices and compute returns in other ways. For example, we can directly use TOC NBBO files, like NBBO files, and use the participant timestamp. And those are the prices with a timestamp at the time when each exchanges send out the data to the data collector. So previously, the TOC data shows a SIP timestamp. That timestamp is at the time when the data collector received the prices. So here is the result using the recent data, May and August 2020. And as you can see, using TOC and the TOC participant has much higher return predictability using machine learning compared to all the other ways of constructing returns. Right, so here's a question. Why are returns predictable only if using quotes in sequence, as in TOC, not in other conventional way of constructing returns? So when we look into the data, we find those spikes. And here is the evidence in IBM stock, which is a highly liquid, large cap stock. And we show here four ways to constructing returns: TOC, TOC NYSE, TOC NBBO, and TOC trade. And you see those spikes coming from the TOC. If we zoom in on a day, which is August 12th, 2020, you will see those red lines in this graph. That's using TOC, directly to constructing returns, but not the other conventional ways of constructing the prices. So here we want to investigate whether or not these spikes are the reason that using TOC has strong return predictability. So how about we remove the spikes? Will the return predictability gone? So here we set different levels of thresholds from 0.5 to 0.4 and then 0.1. So meaning that we drop any midpoint prices if it's X% different from at least 6 of the 10 surrounding midpoint prices. So the higher the X, that means the less strict the threshold. The lower the X, for example, 0.1 here means we remove more spikes. So let's see the results. So panel A shows the results for historical data 2005 to 2012, and panel B shows more recent data. So it shows that the more spikes we removed, compare 0.5% and 0.1% threshold, we find that the return predictability, denoted by the adjusted R-squares, dropped more. Similar for the recent data, May and August in 2020 and 2021. So in conclusion is that this paper documents the importance of how returns are constructed on return predictability. And in particular, there's no predictability using conventional ways, directly using prices from the certain exchanges or using the national best bid and offer prices or use the transaction prices. So there's no predictability using these data sets to construct 1-minute returns. And we find data artifacts due to the spikes, leading to negative autocorrelations, which brings large return predictability. So we thus advise against using such a way to construct prices, whether for estimating returns or liquidity measures. So this is the first paper ever discussing the data usage and data sensitivity in high-frequency trading research. And so next time, if someone claims to crack the market, ask, is it real or just an artifact? Thank you.
Hi folks, we will just open up the floor for a few quick questions, followed by a coffee break right outside the venue at the door.
Hi, my name is. I just have a question. So it's not. So can we use like LSTMs or transformers like models to capture the long-term temporal dependencies to actually get some good returns? Is it possible with these, if not the traditional?
Sorry, is it possible to use what models?
LSTMs, long short-term machines.
LSTM models, long short-term memory.
To capture the spikes or data artifacts?
To actually get good returns, like 1-minute returns.
You can try. So it depends on the nature of the model. So in our case, we are using the linear regression. So that makes sense for choosing lasso. So it depends on the nature of your model. So yeah.